Well, let's get started. And I'm going to continue to admit people. I've got my three screens set up, and unfortunately, my poor camera over here, as opposed to the one that I normally like, which is up here. But welcome, everyone. My name is Colin Day. I'm a financial advisor, Correct Capital Wealth Management. You are joining me today on our quarterly webinar series. This one is called Understanding Income Taxes. And yes, you have more influence than you think. Because when it comes to income taxes, and you might find this weird because many of you are coming to us because we're your 401k advisor, we think about income taxes as maybe not the thing of interest to most people that are just trying to put their head down and save. But I think a lot of the overlooked things that we go through, especially during tax season, which for most W-2 employees is the only time that you're interacting with taxes, is there could be some opportunities for at minimum understanding. So for some education for you all in terms of how taxes actually work in the U.S. But then also taking this information, coming back and thinking, are there some things that I could do from this particular webinar that can help improve how you're handling things like taxes going forward? So for today, this is just a general disclosure. This is a friendly reminder. Even though I'm an enrolled agent with the IRS, no, I don't have a badge. I just have the certificate. This is not tax, legal, or investment advice. This is general education. If you have questions, I'm happy to answer them to the best of my ability. But I always know when I need to say, sounds like you need a competent tax preparer to maybe answer some of those more detailed questions for you. If you do have questions for me during the presentation, feel free to type them into the chat. I'll try to keep them in the corner so I can see them as things are going on. If you do need to unmute yourself and ask a question, I would ask that let's do that at the end of the call. I can always go back to slides if there are questions. Okay. So for today's conversation, we're going to start here with what are income taxes? How are they determined? The different kinds of things we need to consider when we think about our income taxes, and then what you can do about it, and then frequently ask questions. And then, of course, there'll be time for questions at the end. So what are income taxes anyway? And for our presentation, what we're going to be talking about mostly is federal income tax, because you all are calling in or attending this in various states around the United States, which may or may not have income taxes. So we're going to focus on the federal side. But taxes are the money that's collected by an authority and imposed on a population to raise funds for publicly available infrastructure systems and services. Not a very technical definition. It's just basically saying, hey, you're paying into something that everybody gets to use. And so thus you get to participate by paying, in this case, the federal government for access to those particular facilities. Now, when we think about income tax really isn't all that old in the United States. So if we think about this country being in existence for about 250 years, the first income tax wasn't actually levied in the U.S. Until 1861. And if you can think about what was going on during that time period, we're talking about the Civil War. Now, it was repealed not long after the Civil War because the funding effort ended, but then an official income tax was ratified with the passage of the 16th Amendment back in 1913. That's the first time that we actually came up with income tax brackets. And we think about what those income tax brackets look like compared to where they are today, very different situation. And income tax brackets do change. If you go through the history of how the brackets have moved around over the years, you'll notice that it's not always neat and tidy in terms of what those rates are. We are in right now a very interesting time when it comes to tax brackets, and we'll touch on that in a little bit. So how is income tax determined? So if you are a good tax-paying individual, this isn't going to come as some kind of shock for you, probably not too much information that you didn't already know. But because I do field a lot of questions on how income tax works, and it's not just exclusively people like in their 20s, this is their first big boy, big girl job. This is people in their 40s and 50s that never realize this. We're going to make sure that we level set. So first of all, we have income tax. So the U.S. income tax system is known as a progressive system. So that means that we reach breakpoints. The more money we make, we have to pay a higher percentage in taxes, in this case to the federal government. Now, we're going to use Erin as an example. So Erin is a single individual. She's 26 years old, and she makes $58,000. So we're going to use her to kind of explain some of these taxes. So if we think about the 2023 tax rate information, that's what's over on the right side. Those are the income tax brackets that exist for all income tax payers. Now, the tax rates over on the left, you'll see that they go from 10% all the way to 37%. So if you're making buku bucks doing whatever you do for a profession, the highest percent that you pay from an income tax specifically perspective is 37%. But it's not that all of your money might be taxed at 37% if you're making, again, well into the six figures, but rather you are going to move through tranches of these tax brackets before you have to owe on some of your money at 37%. So, for example, if you make taxable income between $0 and $11,000 last year, you'd pay taxes at 10%. Okay, so if you make between 0 and 11,000, you're going to pay at the 10% rate. Once you cross 11,000, $11,001, between that and 44,725, you pay 12% on that money. Okay. Now, Erin, in her case, she goes into the 22% bracket because she made $58,000 last year. And so because she's between 44,726 and the 95,375 you see on the right, her highest bracket is going to be the 22% bracket. So again, as a visualization, if you're a visual person, how this works again, as we fill up the bucket, we started at the 10% at the bottom, the first 11,000, then the next, 33, 34,000 is taxed at 12, and then the remainder is at 22%. And if you are very into taxes and you know exactly what I'm talking about here, you might be saying, hey, Colin, what about deductions? And we're going to get there. Slow down, please. This is a very simple example just to kind of illustrate the fact that, yes, this is a progressive system. So interestingly, if we were to think about how these rates work over time, again, we can kind of see the exact dollar amounts then that Erin might owe based on the amount of money that she made within those brackets. So over on the right side, you see my math there. So we can see her total tax is $8,067.16. So that's what would be on her 1040. And we'll go to an example of that in just a moment. So her marginal bracket is going to be the 22% bracket. So when somebody asks you, hey, what tax bracket are you in? Which would make a very weird dinner party conversation, right? If someone's just asking you what bracket you're in. But if you did have that question, or if maybe a tax preparer that you're thinking about working with wants to have information on it, you could tell them I'm in the 22% bracket. However, the effective tax rate, that's the averages. So this is a weighted average of all those dollars that are in there. So we take the 8,067.16, we divide it by the 58,000 that Erin made in 2023, we can see that her effective rate is about 14%. So again, just because she's in the 22% bracket doesn't mean that all of her money is taxed at 22%. Okay. Hopefully I'm driving home that point here. If this is news to you, I'm really happy that we're having this conversation. You're really going to value the rest of our conversation today. If you already knew this stuff, we're going to get more technical starting right now. Let's go into breaking down how your income taxes get reported, how you think about them, and again, maybe some ways that we can legally, of course, manipulate them in a way that might be more advantageous than perhaps what you're doing right now. So we're going to start with an equation because all good tax conversations start with an equation. So we want to make sure that we're all on the same page on how we're going to approach this. There's going to be nuance to this that I can't really talk about in this presentation, mostly because it's just going to be, there's just too many avenues that we can go down. But this is going to be some general guidance on how we're going to talk about tax today. So first off, we're going to start with that gross number of income. We're going to talk about how much money you're making. From there, we're going to talk about the various kinds of adjustments that exist against your income. So we get to subtract them away from your gross income, which then results in what's called the adjusted gross income. So if you've ever heard of that, also known as AGI, this used to be at the very bottom of your 1040 back in previous year editions. That's what we're talking about. So adjusted gross income is a thing. Then we're going to talk about deductions. There's two varietals that we'll go over. Then we're going to get to our taxable income by subtracting yet further deductions from there, and then credits, which then gives us the total tax bill. So what you're seeing here is that these are all the good things that can happen to you. And what I mean by that is, we start with your gross income, and here's all the things that we can nip and tuck, so to speak, and we can improve your tax situation so you don't owe quite as much. Now, there are things, of course, that will add to it. But for most W-2 employees, this isn't really a concern because there are some things, or especially if you were like if you're on this call and you're worth, $10 million, call me afterwards, of course. We can talk about some other things. But unless you're making really big dollars, it's mostly that you're looking for the advantages of reducing your tax bill based on the opportunities that exist. We do have to consider other forms of income, but we're not going to talk about those today. We're just going to try to keep it nice and simple. And we're going to follow this equation through the rest of the presentation. So first, we're going to start off at income, right? This is an income tax conversation. We should probably start there. Here's a copy of the 2023 income tax form And this 1040 document, we should all be familiar with this, even if you don't do your own taxes. This is the, besides maybe a letter from your CPA that's putting this together, this is generally the on the cover of everything that gets submitted to the IRS. So it starts innocuously enough, right? It just starts with your personal information. They're trying to ease you into the tax journey. And then it's just going to ask a little bit more prying information in regards to, hey, you single still? Are you married? How are you jointly or separately filing on your taxes, et cetera, and so forth? There's a new section right there that you might see called digital assets. So that's going to be more prevalent of an issue with the IRS because they're trying to make sure that you're not hiding your money and all your earnings in crypto. They want to make sure that, hey, if you're selling a bunch of stuff, your NFTs that have fallen apart or whatever, they want to make sure that you can report those losses, or more virtuously of the IRS, they also want to know about the gains, right? They want that tax revenue. So it starts off innocuously enough at the front part. Now, most of us on this call are W-2 employees. Okay, with some exceptions, you might be maybe do a part-time gig that you do as a contractor. Maybe you have your own side business. For all I know, we're going to focus on the W-2 because this is the easiest one to make sure that we're all in the same place. This is just an example of what a W-2 could look like. Now, when it comes to what is your income, most of the time, that's just going to be the in box number one of your W-2. That 23,500 in this example for John Smith from anywhere California, that is the actual wage that is going to be reported on his 1040. There's other things on the W-2 that we're going to get to in a second, but what you need to know right now is the box one gets carried over back into that 1040. So again, started easy on the 1040. This is the second half of the first page of your 1040 document. Where the information goes for income goes right there in box one. 1A in this case. So you're filling in over on the right your income number from your W-2. So if that's all you do for a living, you go to work, you go home. You go to work, you go home. You don't do anything else. More than likely, that box one is going to be all the information that you need to fill out in this particular section to get started. But if your life is a little bit more complicated, which is naturally what ends up happening, there's this fun document called the Schedule 1. And this is where your additional income gets reported, as well as adjustments, which we'll talk about a little bit later. Now, on the front page of Schedule 1, and by the way, this is an effort of the IRS to make our lives simple, to say, hey, the 1040 should be as simple as possible to fill out. Well, let's not make it too complicated. But what we'll do is we'll just create a whole bunch of other documents called schedules that then feed up into this document. So what you see is the 1040, and technically you can glean a lot of information from it, but all the real nitty gritty stuff is all just hidden behind in other forms that your tax preparer have to deal with. So for example, I'm not going to go into too many details here, but some examples of additional income could be, some tax refunds that you've received in the past, or if you're getting alimony from an ex-spouse. You might have rental real estate that's actually reported on a Schedule E, but still needs to go into Schedule 1 for some reason. Or you own a farm and you want to report your income or losses. That could be reported from a Schedule F and then fed into Schedule 1, and then et cetera and so forth. I'm not going to go through all these. I will let you take a look at your Schedule 1 example. If you just type in Schedule 1 IRS or something like that into your Google machine, it will pop that up for you. Now that information, we go back to the 1040. This info goes into box 8. So that's the additional income from Schedule 1, line 10. Line 10 is at the very bottom. It's just the gross number that goes in there. Now, when that information gets put in there, we basically have all the basic info when it comes to that income equation. So all we've resolved right now of our equation, if you remember from a moment ago, is the income line. That's it. So let's get more complicated. Let's talk about adjustments. So adjustments are, in our particular situation, we're going to call them the favorable things that reduce your income, like stuff that happens on your W-2. So when you get your W-2 and you look at that box 12, as you see the box 12 in the W-2 example here, there could be a bunch of codes. Like in this example, it's a W. There could be many, many, many different letters. I looked up the other day, I think it's over 30 different code letters that could be used to depict some kind of benefit that you're receiving through your employer, which is either not reportable at all on your taxes, or it could adjust, it could lower what you're receiving. So for example, here's a bunch of different codes. So D is probably the most familiar that people would see on their 401k, or I'm sorry, on their W-2, because that's the 401k pre-tax deferral. On the other side, if you have double A, that's actually the Roth 401k deferral code. So if you've been putting money in, that money, all those dollars and all these codes from box 12 actually feed into box 1 and either, again, keep it the same or decrease it. You might have employer-sponsored health coverage. That's a pretty common one as well. And then the W that you see as the example here, this is actually employer HSA contributions. Okay, so anything that's going into the HSA might get reported in that way. If that was also reporting your contributions, that means that John Smith might have actually made $24,000 for all I know, depending on how they're interpreting that code. So when it comes to the adjustment side, so again, we talked about Schedule 1 a moment ago, and we were talking about how that's where we're reporting additional income. Well, this is the other part where we call them adjustments. So again, reductions for our purposes today. And some common examples of adjustments that you might see would be like an IRA deduction. So if you're underneath the income cap, I put money into a traditional IRA. That's where I'd put in my IRA contribution. And then based on the calculation, do I get the full deduction, a partial, or none? But that would be listed there. So that could reduce your income. Another thing that you might have seen here is student loan interest. So if you've got a student loan where you're eligible to claim that interest deduction, you could list it there. Or up further, you might have an HSA that you're contributing out of pocket, maybe not affiliated through your work, so that's not reported on your W-2, but you still want the deduction for it. So that's where you would list something like that. All that information then just gets fed down to the bottom. And again, you're going to see, hey, it's going to go to the 1040. It's going to go to line 10. And we go back to the 1040 now. And we go to line 10, and that's where we insert it. Okay. So we had our income, had our adjustments. We took the income, we subtract the adjustments out of there, and then we end up with our AGI, our adjusted gross income. Okay. That goes over there in box 11. So we've done a lot of work, right? We reported all of our income. We offset it with some of the deductions, the things that we want to hopefully, the adjustments, excuse me, that hopefully reduce our income tax bill. So what have we done? Again, we had our income. Then we got to the point where we were talking about our adjustments, subtracted those out, and then we get to the AGI, the adjusted gross income. So now let's get to the next part, deductions. So deductions are the things that many people are familiar with, of course, but there's two different varieties that we're going to talk about. There's a very common way for people to use deductions on their 1040, and then there's a more advanced way of doing it. And we'll talk about why people do one or the other, depending on their given situation. So number one, a deduction is something that reduces the taxable income number. Okay, all we're doing is we're taking this number. So again, after adjustments, and now we got the AGI. So how can we reduce it even further? So most people, when we think about the two different varieties of deductions that are available to us as tax filers in the United States, the most common one is called the standard deduction. So the standard deduction is a deduction on your income that everybody gets. Okay. The amount, however, does depend on how you file. As an example, I've listed single filers and joint filers here. There's a different one for like head of household, if that's your tax filing status. I didn't list that here for simplicity reasons. I just put these two. So for example, if you're a single individual, you automatically get a deduction without you doing anything besides filing your taxes, of course, to get $13,850 off. If you're a joint filer, it's $27,700. Okay. So these are the 2023 numbers. Now, the other way that you can take a deduction is called the itemized deduction. To be eligible for an itemized deduction, you must exceed those types of numbers that I just showed you for the standard deduction. Otherwise, it makes absolutely no sense to itemize your deductions. For most couples that I'm doing a tax return review on, so like our clients, when they send me their tax returns, the vast majority of folks are just taking the standard deduction. I think it's somewhere around 90% of all tax files are just using the standard deduction. And it's just because to get an itemized deduction, you have to do a lot of work now. Because of the Tax Cuts and Jobs Act of 2017, from 2018 to 2025, the standard deduction is much higher than it has been historically. And that's why so many people just say, I can do the standard deduction. It's why when I try to find their Schedule A, I can't find one when I do a tax return review. It's because we just didn't even go through the effort of doing the itemization because you are nowhere near the $27,700, Mr. and Mrs. Smith. It didn't make any sense to do it, the exercise in the first place. But if we're going to do the exercise, just to, again, educate you all, The way that itemized deductions work is that you're looking at major areas to determine, do I have the ability to itemize in a given year because it makes financial sense for me. So for example, you might have medical or dental expenses that exceed 7.5% of your adjusted gross income, meaning you've got major medical bills that impacted you. You might be able to itemize those particular expenses that exceed the 7.5% of the AGI number that we talked about a moment ago. You might have paid state and local taxes. You might be able to deduct up to $10,000 there if you've paid those. You might have home interest. So if you've got some kind of mortgage interest, maybe even for a HELOC, if that's for the purposes of working on your home, you might be able to deduct the interest that you pay when you get that tax form from, for example, your mortgage company. And then finally, you've got gifts to charity. So those types of contributions, there's some rules with that as well. But if you have sizable deductions, so I own a home, I pay state and local taxes, I'm at the beginning of my mortgage, so I have a huge interest expense. Maybe I did run into a medical calamity of some sort, or my child did, or something like that, and that allows me to do more deductions that could be available to you, et cetera, and so forth. But again, it only makes sense to go through the effort of itemizing your deductions is if you think those numbers exceed the ones that I put on the left as an example. Okay. So where does this go? Let's revisit our friend 1040. We are still in the same section. We're just moving to a different line. We're just going one below the adjusted income, adjusted gross income number. We're going to box 12, which is where we list either the standard deduction or the itemized deduction number. So again, you already have banked your standard deduction number. It's if you exceed that we would put the itemized number there by using the information that I just mentioned. After we get there, we had the adjusted gross income number, we subtract the deductions, and then we get your taxable income. So finally, we've approached the end of page 1 of your 1040. So let's go back to the calculation just to make sure we're following along. We've got the income. We subtracted the adjustments. We got our AGI. We then subtracted deductions. And then from there, we got our taxable income number. Okay. Now we get to the good stuff. This is well, this is all good, right? But this is the better stuff, let's call it. These are credits. Okay. So tax credit, different from a deduction. A credit is a deduction. It's basically taking the concept of a deduction is only going to limit or decrease the amount that's subjected to tax, whereas a credit will reduce the tax bill. All right. So let's use an example. Let's say I have a $200 deduction and I'm comparing it against a $200 credit. So if you take a look at the chart there, and this is just from an IRS tax tutorial, super fun thing to do on the weekend, I'm sure. The effect of the deduction on income subject to tax, we can look on the left. If you have $10,000 that is subjected to tax, and as an example, they use 15% as the percentage. So if you have $10,000, 15% is $1,500. So that's the amount that's subject to tax. However, if you had in your pocket a $200 deduction for some reason, that money gets to reduce the income subjected to tax, reduces it from 10,000 down to 9,800. 15% multiplied by 9,800 is $1,470. So effectively, you have reduced your tax bill by about $30 by having a $200 deduction. Let's compare that to a credit. So in that same situation where I don't have the deduction, I made the 10,000, so I owe 15,000 or 1,500, excuse me, on my taxes. If I have a $200 credit, well, the credit reduces the tax bill of 1,500, so I get to subtract $200 from it, and what my actual tax bill now is $1,300. So again, in the deduction scenario, that's the $1,470. So that's what I get in that scenario. But if that's a $200 credit instead, I pay $1,300. That's why people want credits, not deductions. I'm not saying, hey, don't get a deduction if you're eligible for one. But if there is a credit that's available, that's going to be the more lucrative opportunity. And it's not an either or. I'm not trying to say, hey, if you have a deduction, you should do the credit version of that. That's not what I'm saying. What I'm saying is that the credits are more valuable to tax filers than a deduction is. Okay. Now, where do the credits get reported? Well, there's a section at the top of page 2. If you didn't know, there's a page 2 now of the 1040. Now, this is it's kind of a land of misfit toys, to be honest with you, this section, because it's talking about additional taxes that you might owe, but then it also will allow you to put your credit information here. Why? I'm not exactly certain. But the most common credit that people file for are those with kids. So if you have a child underneath, I think it's age 17, you're eligible for a child tax credit. Normally that's $2,000. There a couple of years ago, those are different now, numbers that don't exist anymore, but generally speaking, it's around 2,000. So you have to file an additional schedule, again, 8812, but this is where you put the most common credit that exists. So that would reduce your tax bill. Okay. So on 16, the box above there at the very top of the section, that's where you're determining the actual tax number, like how I showed you the dollar amount for Aaron in the example. That's where that number would go. We would offset this by the number of credits that are there, and then we would end up with the total tax number at the bottom. So again, let's go back to that calculation. We have income. We have the adjustments. We have then the adjusted gross income. We take out the deductions. That gives us our taxable income. And then finally, we subtract the credits, and then we get to total tax. So that's a lot of information, right? Especially if you're not terribly familiar with tax. If you were to screenshot anything, you might want to screenshot this because I think it does help break things down. And if as you look at a 1040 alongside this equation, it should make your life, well, maybe not easier, but hopefully it helps you comprehend the aim as to how we file taxes. So when you hand your stuff over to your tax preparer or you start plugging in information into TurboTax, these are the kinds of things that are happening in the background that get affected by every dollar that you put into the system. So now that we have this background, what can we do about taxes? And just like this woman who I love finding these images to associate with different types of themes. I just love the idea of just holding up a big old calculator to somebody and being like, look at this thing. What can we do about this woman and her question about holding up a calculator and how does it relate to taxes? Well, some of the things that I preach to our clients is number one, think about incentives. So think about, like, as an example, purchasing an electric vehicle. So like right now, there is a tax credit. There was all these various things that could have happened with it, but ultimately it resulted that there's a max tax credit for purchasing a qualifying electric vehicle for that would give you $7,500 as a credit. That's a pretty big credit, right? That's cool. So it's the government basically saying we are incentivizing people to move off of combustible engines to an electric vehicle. There's lots more rules with your eligibility for it, but the idea here is that the federal government in this way, they're incentivizing you to consider the kinds of purchases you're making. Same kind of idea like with your local utility company. Hey, I need a new water heater. This was my life last year. So we looked up, okay, if I put in a new water heater, if it's of a certain kind of energy efficiency level, well, I can get some money back as a rebate, not just from possibly the federal or the state government, but also from the local utilities as well. So we think about our incentives when we think about our taxes. Then we need to think about the long term, not just the short term. I'm fairly active on social media. We talk a lot about long term versus short term. Lots of people want to fight to reduce your tax bill to zero. And that's super cool, but not often does it mean it's zero for your lifetime. It just means you're pushing it off to another day. So pre-tax versus Roth of that. Does it make sense to get the deduction now on your pre-tax contribution, but needing to pay taxes on all that growth in the future, whereas you could pay your taxes now at your current rates and a Roth contribution, and then likely not pay any taxes on the earnings? So these are the things that we think about when we think about the short-term and the long-term approach to tax savings. And then, of course, and this is the hard one, right? It's, get to know your tax return better. It's doing the work. It's, hey, I got this thing back from my tax preparer or TurboTax pumped this out. What does this mean? What can I learn from this? If you're asking the question, you're already doing more than most, to be honest with you. But it's getting to understand the numbers. Hey, I saw this form. What is this 5329? What is this 8889? Whatever this tax form is that you're looking at, is there something I could learn by looking up that form, finding information on a forum like a TurboTax? There's lots of people asking questions there, Reddit, whatever it is, to learn a little bit more about your taxes, or just ask your preparer. If you are working with somebody professionally, wait until like May, until they have their break and then they come back to work, and then say like, hey, can we do a postmortem on this tax return? Could you just like walk me through some of the things that you're seeing here that maybe I'm not educated on, that I didn't even know was going to affect me, and how I can improve my situation going forward? So I'll end here with some frequently asked questions because I know we're already over time. So some of the common frequently asked questions that I get from folks, which you might be asking right now for all I know. So number one, why do I get a refund one year but not the next? And well, think about incentives again. If you bought an electric vehicle, last year, you're going to get a pretty big tax credit at least. Now, whether or not you'll get the whole credit or whether you'll owe anything in taxes or a lot still in taxes, I don't know. But the next year, well, you might not be eligible for that credit. So there are certain things that operate on a year by year basis that exists now and may not be later. The SALT tax, the state and local tax deduction that we were talking about when you itemize your taxes. Well, there's been conversations about increasing that off $10,000 for a while now. If that ever happens, well, that could be a major boon to you on your taxes going forward if you suddenly can itemize and you don't have to take the standard deduction. But those are the common reasons why, some people don't understand why they get a refund one year and owe the next. Is just because things change with taxes. That's what keeps us employed as advisors and for others as tax preparers, because things are constantly changing. And so just because something happened in one year doesn't necessarily mean it's going to be the same in the next. Next is, why can't I write things off on my taxes? Again, if you follow social media, if you're plugged into financial education, social media accounts, this is all over the place. And it's unfortunate because it basically makes it sound like you can just write anything that's going off in your life as some kind of professional expense. Well, the reality is that those types of deductions aren't a thing right now until at least 2026 at the earliest. But also, most people need to have business purposes for the things that they write off, that they are expensing. So if that's not you, if you're a W-2 employee, there might have been a reason to maybe do something with like your home office or things like that. But otherwise, for most people in their lives, the idea, this concept of writing things off is mostly associated with business owners. So if you have a business, you have expenses associated with that business, and for the purposes of running your business, those types of things could be written off as expenses. But for most lay people that are just working on W-2, it's generally not an option. Now, don't I want to get a big refund each year? This goes back to the conversation on the previous slide where we were talking about like pre-tax versus Roth. Well, some people like the idea of just getting big deductions up front so that they can get as much tax as a refund as possible. Some people overpay on their taxes a lot so that they get a huge refund. The IRS doesn't want that for you. They want to make sure that you keep as much money in your pocket so that your tax bill when you file your taxes is as close to zero as possible. Many people will budget their whole lives around what they're going to get as a refund, which is dangerous. Because if you're thinking, hey, I'm spending money, my coffer, my savings account is dipping down because I'm spending and spending and spending throughout the year, and I'm just waiting for that big tax refund to come in and bloop, my savings account jumps up, that's a very dangerous game to play. Because as I said in that first frequently asked question, how do I get a refund in one year and then I owe on the next one? Well, what happens if that's you, right? What happens if you're anticipating this is the money that's going to be paying my property tax bill, but taxes have changed, your situation maybe changes very slightly, and then suddenly you're not eligible for certain kinds of deductions or credits, and now all of a sudden you're left with a much larger tax bill than you anticipated, and now instead of getting a healthy sum, now you're owing. The idea is that we don't want a big refund each year. We want to be as close to zero as possible. We want to keep as much money out of the hands of the IRS and in our pockets so that we have the ability to spend it, not giving a short-term loan to the federal government. Finally, don't I want to minimize my taxes every year? Again, this again goes back to the previous comments about pre-tax versus Roth as an example. We want you to pay as little in taxes as is legally required by you throughout your lifetime. And sometimes that means, yeah, you might be paying a little bit more taxes than you want to in any given year. But the idea is that we do some things to benefit future version of me. It's like when I do the dishes at night, right? Future me, Colin the very next morning, will be happy that the sink is empty and that I can, do the things I need to do in the morning to prepare my kids for school. But if previous me didn't do the dishes, he's gonna be very upset the next morning when he realizes that past Colin kind of screwed things up for him. We want to make sure that we are doing the types of things that we can over time. So again, cleaning out the sink, doing the dishes, paying some taxes for the benefit of long-term planning. Okay. So when it comes to your frequently asked questions, you might have your own situation that might necessitate you talking to your tax preparer about it. But if there are questions, I am happy to take them. My contact information is listed there. John Biedenstein and Alexia Keel are also other representatives on our 401k side. If that's how you're coming to me today and you have questions, they'll be happy to answer some of your questions as well. So I'm going to pause. I'm going to take a drink of water. And if you have any questions, feel free to unmute yourself if that's something you're interested in doing, or if you just want to type into the chat, I have the chat open here, and I'll be happy to answer anything for you.
I do have a specific question about my situation, just kind of curious.
Okay.
Um,
And I'll say this, Scott, if you're comfortable sharing it with the group, cool. If you
I
want to
am.
send me an email, that's fine as well.
Oh yeah, yeah, no, I don't mind at all.
Okay.
Just because it might help me point me in the right direction on something. So for quick recap of things, uh, got married last year, very exciting. My wife is from Japan,
Hmm.
and she has not worked yet because we went through the full process, but we have her. Do you know what kind of style I should fill out for like marriage? Should we file jointly or separately?
So, well, good question. So
Yeah,
the
sorry.
question of whether you're eligible to file
Okay, so
jointly,
so it's
that's really going to be the question
eligible.
here. Yeah. So if
Perfect.
you're
Okay.
eligible because you are married at the
Hmm.
beginning of or basically how they're going to look at it is that were you married on 12/31/23? And it sounds like the answer is yes, right?
Yeah.
Yeah. So if you were married at the end of last year, you can file as a joint couple. The other option
Okay.
that you have is separately, which
Hmm.
I mean, depending on your situation, it might benefit you, it might not.
Okay.
Most people that are married, again, as of the last day of the previous year, will file
Hmm.
jointly because the tax benefits are generally greater. There are some nuances there as to where
Yeah.
separately makes more sense.
Hmm.
But from a working perspective, that's really not the question there. It's mostly just the marital status that's going to be the
Marital status.
question that you need to answer.
Perfect. Thank you.
Sure, you're welcome. Any other questions? I don't see anything in the chat. I do see that Tom and Jerry is a great name for a dog or maybe mice. I don't know.
I do have I do have one more if no one else has one.
Floor's yours, Scott. Go for it.
Okay. I find it interesting on the itemization part of it because as long as I can remember, I think I've only itemized one time in my life, and that was a long time ago, over 10 years
Mhm.
ago.
Okay.
Um, Even on some of the forms, because I use like a TurboTax software and I fill it in, when you do donations and stuff, like
Hmm.
let's say Goodwill, they give you a sheet, you write it down. The only time that sheet matters is if you get audited, right? Because otherwise you just type it in, or how do you send it with it
Yeah.
if you have to itemize?
No, you need to keep detailed records of things like donations. So whether it's clothing, like a
Mhm.
Goodwill, or you've donated cash to
Mhm.
local food bank, whatever it might be, um, that kind of information generally is going to stay in your pocket. It's going to stay in your tax file
Okay.
just in case. Now, again, it's if you itemize that year, that's where that matters, right?
Yeah.
Because
Yeah.
you
Yeah.
use the itemization deduction ability to get the higher amount over the standard deduction. If you made those types of donations, it doesn't hurt to keep them in your file just in case,
Hmm.
just more for tracking. But if you do the standard deduction at the end of when you're doing your TurboTax,
Hmm.
then it doesn't matter because
Yeah.
those numbers didn't come to be. They didn't come to actually matter against your tax return. So, but if you did an itemization and it works out that it's higher than your standard deduction, then cool, that's great.
Hmm.
You want to keep all that information on file. The types of things they generally recommend is like, okay, what was the dollar amount, the date of the donation, where's the receipt? Did
Hmm.
do you need some kind of confirmation between parties that this has been received? Thank you so much. Blah blah blah, that kind of thing. That's kind of stuff you just tuck into your tax file.
Okay. Perfect. Thank you.
Sure. All right. Any other questions? Okay. Let's leave it there. If anybody does have personal questions for me, you got my email right there. Feel free to shoot me a note, and if it's appropriate, I'll try to answer as much as I can in the email. If it makes more sense for us to reconvene um, via video, hopefully my other camera works at that point, or what have you. I'm happy to do so. But in any case, thanks so much for joining me this afternoon. Hopefully this was helpful to you. If you do have anything, feel free to reach out. Thanks, everyone. Have a great day.
The opinions expressed in this program are for general informational purposes only and are not intended to provide specific advice or recommendations for any individual or on any specific security. It is only intended to provide education about the financial industry. To determine which investments may be appropriate for you, consult your financial advisor prior to investing. As always, please remember, investing involves risk and possible loss of principal capital. Please seek advice from a licensed professional. Correct Capital Wealth Management is a registered investment advisor. Advisory services are only offered to clients or prospective clients where Correct Capital Wealth Management and its representatives are properly licensed or exempt from licensure. No advice may be rendered by Correct Capital Wealth Management unless a client service agreement is in place.